Hi, good morning, everyone. This is a video to talk through the indicators that I use, why I use them, and I might spill into Heikin Ashi candles, which you could argue is kind of an indicator, but I don't think it is. So the indicators that I use, I try and keep them simple. Now I've used quite a few Bollinger Bands, for example, which get quite exciting, MACD, and there's plenty of others that are out there, which you can Google, watch on YouTube, etc. Now, what you'll hear time and time again is you want to have the least amount of indicators on your screen to do the job. So what I mean by that is you could pick all the indicators that you've read about. So there's Bollinger Bands here, EMA Crafts, brilliant, MACD, lovely. There's plenty. Some of these I don't know about. The RSI, which is good. That's one that I do use. But there's quite a plethora that you can scroll through, and this is free just on Bybit, the exchange that I use. So I use, let's have a look. I'm not going to count, but we'll get there at the end. I use primarily the EMAs, the exponential moving averages. I use the RSI, and I'll explain what I use that for in a moment. And I use Heikin Ashi candles. Let's just go through those one by one. So moving averages, as the name suggests, gives you an indication on average of the direction of the market. And you can choose various properties or settings within there. I'll let you Google them, but effectively the length is how many candles are used to calculate the current moving average value. So if you go back to normal candles here, if you're using 50 candles, what that means is to calculate this point here that's on this 50 moving average, you would go back 1, 2, 3, 4, back to 50, whatever the number is, and you would sum up what that is, divide by 50, and you get your average, and you plot that on the graph. And the average price at that point is the average of the last 50. That's called the simple moving average because you take the total number from aggregating the price, divide by the total number of candles, and that is your average. Now, I like to use the exponential moving average, and there's a formula for that. You can Google it, and it effectively means that the weight or the impact to your moving average score is more heavily weighted to the current price. So where you see a graph undulating lots, if there's a huge spike, for example, back here, and it's at the tail end of your 50, with the simple moving average, it will have an equal impact to what the moving average score is, whether the huge spike was here, or in the middle, or at the start, more recent. The exponential moving average, the calculation gives more weight to the size or the price undulations closer to present time. So if you have a big spike here, then your moving average will be impacted much more than if the same size spike appeared back here. So the reason why I like it is it smooths out, or for me, it gives me a better indication of where the market is currently, as opposed to, as the name suggests, a simple moving average. It just works for me, and it just works for my strategy. Now, I use the 50 and the 200 period. And the reason why you might want to use different periods is the more candles that you involve in your calculation, then hopefully the more accurate it is. Accurate is a loose term in this sentence because what it means is if you're running, we're looking at 15 minutes, then I can't quite do 200 times 15 in hours in my head quickly enough, but you're spanning several hours worth of candles to give you an indication of what the moving average is. And what you're really looking for is an indication of the trend. Are we going up or are we going down? That's why I use moving averages. So if you only use, for example, 5 candles, let's do it right now. I'm going to put on moving average, and we're going to set it to, and we can change this, which is quite nice. I'm going to set it to 5 candles. You can see how it fluctuates quite aggressively. And it's very hard for you to determine, well, are we going down or are we going up? Are we going down or are we going up? So as you increase the number of candles that are used in that calculation, it smooths out the curve. So it gives you a better idea of whether you're consistently going up or going down. So that's basically what averages do. And the moving average just means that you calculate it moving forward in time. So I use 50 because it's a good number of candles to use to give you an idea of where the short-term trend is going. And I use 200 to give me a better idea of the longer term trend. But also, because you're ultimately trading against lots of other people, financial institutions is a good example. They use the same indicators and they use 50 and 200 from what I gather. So if you have an idea of what they're thinking of doing, then you're better placed to hopefully take the profit. So I use 50 for the shorter term indication of the trend. And you'll see here how it does change. So if I scroll back, the 200 is fairly flat and the 50 is wobbling around. So it's going up, it's going down, it's going up, but the 200 is fairly flat. So the 200 is a pretty good indication of whether you're in an uptrend or a downtrend. And the 50 is used for my strategy just to determine whether if the price is above it or below it, then you want to enter that trade or not. So that's the 50 and the 200. Now the RSI I don't use that often in my continuation trend strategy, but I do use it in my reversal. And the beauty of the RSI and what you'll see here is the settings are slightly different to the defaults, where I've got a solid line on the 50 and I'm looking for the signal, I'm looking for the RSI line to be, if it's above this 50, then I believe that we're in an uptrend. And if it's below it, then I think we're going to head down or something to that effect. And I'll cover that in another video. But the RSI is a good way of seeing divergences. And that is a topic for definitely another video. So I use the RSI to give me an idea, are we overbought? So I believe somewhere around the 80 mark is overbought, and I would expect the market to cool off. And if we're around the 20 mark, then I believe that we're oversold and I believe that we're going to likely head up. So all it does for me is it says if the market is at a high, so we're up here from an RSI point of view, if you're looking to enter another long position, that means you're looking for the market to carry on going up. Just be aware that the market is likely to be overbought, i.e. it is unlikely to keep on going up. I say unlikely, it's not guaranteed. So there are days where the market will keep on going up. So here we are, we hit 85. I would not want to enter a long position, but lo and behold, I was wrong and the market shot up. But you can see here that it corrected. It went down. Likely, if we've got stop losses around our 200 EMA, it would have been triggered. But what it means is if I'm looking to enter, so for example, there's a good little green wave here, I go, oh, that's exciting, I might want to enter. You might want to just be aware maybe the market is going to turn around and shoot through the floor. So just be ready. So the RSI for me is used as kind of an indication to be aware, not necessarily to make decisions. So we've got the EMAs, we've got the RSI, and the last one that I want to cover off is the Heikin Ashi candles. And I wouldn't say these are indicators per se. What is a Heikin Ashi candle? Why do people use them? So right now you can see that these candles undulate. There's some green, there's some red, there's a mixture. And it's very hard, typically, especially for novices like myself, to see, are we going to continue going up or are we going to head down? Are we going to reverse? What is the market doing? It could be consolidating, which means it's just wobbling up and down, not really going in any particular direction. So Heikin Ashi is a way of calculating a candle where it uses the previous candle in its calculation for its current one. So what you'll see is in these traditional Japanese candles, the open and the close never overlap. Yes, the wicks overlap, but not the open and the close. Sorry, I lied. That's if they're in the same direction. When you see here a change in direction, the open was up here and then it fell. So if you look at Heikin Ashi, they are more or less always overlapping. You'll also notice that the wicks have been reduced. If I go back to Japanese, boop, you'll see there's quite a lot of wicks all over the place. There's also a lot of alternation in the colors, green, red, green, red, green, red. If I jump across to Heikin Ashi, because the calculation uses the previous candle in its calculation for the current candle, it, as the name suggests, average bar, that's what Heikin Ashi stands for. Sorry, that is the Japanese translation. It is taking current values of the current Japanese candles and taking into account the previous candle's values to calculate its Heikin Ashi current candle. So it effectively, a bit like the moving averages, it smooths out the the trend or the appearance of the market. So if I go back to Japanese, lots of undulations, and it's very hard. If you take, for example, here, I'm not quite sure what we're doing here. If we're looking at Japanese, I would expect it's probably running out of steam, and it's going to possibly turn down. Now, if I jump across to Heikin-Ashi, oh, it's actually not much better. But you can see that the red candles don't have a lot of height in the bodies, whereas the green bodies, what I'm looking at in particular is there aren't very many wicks on the bottom. So this is strong in Heikin-Ashi world. A green wick on the top means it is going up, especially when there's no wick on the bottom. And these fat-bodied candles really give you that strong indication the momentum is heading up. The red candles, weak. Green, strong. Red, weak. So for myself, it just gives me a better indication of, is the market going in a certain direction or not? So let's have a look at this bit here. We jump across to the traditional. We've got here, first of all, some smaller doji, maybe, certainly some reds mixed in amongst the greens. So I would be wondering, is this market going to turn around? Is it getting weaker? What is going on? Whereas if I jump across to Heikin-Ashi, oops, what have I done? Heikin-Ashi, it's all one solid color. So it gives me more confidence and removes that noise of the alternating colors, that the market is going to go in the green direction, up, whereas if it's constant red, I would believe it's going to go down. And then the wicks are very important because as you see, the wicks at the bottom with no wick at the top means there is strong momentum to the down and vice versa. No wick on the bottom for a green candle and a wick on the top means it's strong indication at the top, heading upwards. In the case of this candle here, a bit of a doji, you've got a wick at the top, a wick at the bottom. You're questioning what's going on next. It's likely to turn around. A red doji, and then we fall. The very next candle, you've got wicks on the top and the bottom. You're starting to see a change in the momentum, and then off we go. So generally speaking, Heikin-Ashi, you'll see a fairly consistent, oh, that's beautiful, fairly consistent color in the direction of the market. And that is why I use Heikin-Ashi. It just helps me have more confidence whether I should go long or I should go short. I hope that's helpful. Please let me know in the comments what you want me to cover, if there's anything I've overlooked or you want me to continue talking about that I may have skipped over. Anyway, thanks very much for listening. Good luck.